Hey everybody, this is Howard, and you're at Otter's Retirement Corner. So, as we all know, the Fed cut interest rates finally. Um, so what do we do now? As retirees or those coming up to retirement, we tend to keep more cash than younger investors. If you're a younger investor and as you probably should be invested mostly in stocks and bonds, don't do anything. The idea that your investments and portfolio will grow over time includes the fact that interest rates go up and down, extraneous events happen, over 40, 50 years, don't worry about it. It's going to work itself out. But for those of us older, 50, 55 and older, we start accumulating more cash. As you know, as I've said in the past, I typically keep 2.5, 3 years of cash, so that if bond or stock markets go down, I don't have to draw from that money and sell investments that are down. So, the nice thing was money markets were paying 5%. The good thing about a high interest rate or a relatively high interest rate from what we're used to at 0% for many years is money markets were paying something on that cash. When money markets were at zero, as they were for many years, it wasn't a good place to keep cash. We had to look for alternatives and take some more risk if we were willing to do that. Otherwise, we may be left 1 to 5 years of cash sitting in money markets earning 0.01% for that time. And generally, cash does not beat inflation. We're in the unique position now where cash returns more than inflation. And I don't want to get into a deep dive of inflation and what you think it is and what it is. Everybody has their own personal inflation rate. You need to figure that out for yourself. If you have a mortgage, your mortgage doesn't change, so your biggest expense doesn't go up. So your personal inflation rate is probably low. Those of us who don't have mortgages may have a higher inflation rate. It turned out that for me, because of the increase in rates, with higher inflation, my cash earned more. So the amount I was earning extra from my investments because of inflation beat the cost of inflation for me. Unique. I'm not saying everybody was like that. Kind of unique. I got lucky or fortunate. Not luck. So anyway, all right. So what do we do now? Like I said, my money market's a lower 5%. It's going to drop. It's going to fall, whether it's 50 basis points like the Fed cut, I don't know. What do we do? They're promising or suggesting that there will be future rate cuts, maybe a couple more this year, maybe, 4 more next year, maybe more into 2026. Who knows? But if that happens and it plays out that way, we're going to earn less and less in our cash. So what do we do with our cash now? If like me, you hold a certain amount of cash as far as number of years of expenses, there's really nothing you can do. You're going to have to eat a lower return on your cash. Here's something I did do though, and I'm not suggesting everybody does this. And I've said this before, I'm not going to predict where interest rates are going. It's such a wild goose chase, I have no idea. But I can predict with some level of certainty what the Fed's going to do. Now, those are two different things. The Fed controls two interest rates, the Fed fund rates, which is the one you hear about. They dropped from 5.25 to 4.75, and the discount rate. Ignore the discount rate. That's the rate the Fed lends overnight to banks. The Fed fund rate is what banks borrow from each other on overnight loans. Now, the Fed fund rate is set. That's what it is. Here's where the Fed's going to target it. Here's where they try to get it. And other interest rates will tend to pivot off of that. But it's not it's not a perfect line. It's not a one-for-one trade-off. So, so what I did is, I knew at some point, for the last 6 months, the Fed looked like they were going to stop increasing. At some point, they were going to lower rates. And when they lower rates, bonds tend to go up in value. So what I did July 22nd, I'll give you the details here. On July 22nd, I took a big chunk of cash and I bought Vanguard Long-Term Corporate Bond Fund ETF. the symbol is VCLT if you want to check it out. I bought on July 22nd. The price was $76.86 at the time, yielding about 5% or so in cash, in interest. So worst case scenario, they didn't change interest rates for a long time, and I pretty much just reaped that 5%, which is what I was getting in my money market. So I didn't figure the downside was very large. The chance that they were going to continue raise interest rates was slight. And if they did, I could wait it out long enough that they were going to stop and come back down. So far I'm up about 6.7%, in 2 months. It's a great return. I made a great move. I'm happy with it. Where it goes from here, my sense is we'll continue to see some interest rate cuts, or if it stands still, I'm still coming out way ahead compared to what my money market was. I'm not suggesting you do this, although I am saying I would think personally that the Fed's going to be accommodating and that bonds will do okay to well. And I actually mentioned this several months back. I just wasn't ready at that point to make that trade. But let me get to another point. So the Fed funds rate kind of drives other rates, but don't confuse what the Fed does with what markets do. The way rates and returns vary in markets are crazy compared where the Fed funds rate is. So the Fed fund rate was at the same, the 5.25 or 5.5, whatever it was, from July 26th of 23 until this week. So well over a year. So if there was a direct correlation between all the other rates would have stayed fairly level to where they are. But let's look at the 10-year Treasury. During this time, it ranged from let me rephrase that. From the time the Fed funds rate was changed in July 23, it was at 4%, and now when it changed the other day, it was at 3.73%. So it changed, it dropped during that time 27 basis points, but the range during that period was 3.65% to 4.92%. So, 127 basis point move, even though the Fed fund rate didn't do anything. And that's because the markets decide where rates are going and where they're going to be. And, if I look at the VCLT ETF I bought, from that time where Fed funds rate were set and until the other day, it went from 77.60 to 81.65, but its range was 67.94 to 81.65, or almost $14 a share, or like a 20% range. So my point is, don't try to predict where market rates are going, but you can kind of guess where Fed is going to go, and then the trend hopefully will be your friend. I'm counting on that. But the bottom line here is I'm not suggesting anybody do anything with their cash. I'm talking a little bit about where I think bonds will go. I have no idea where stocks will go. I'm not changing my stock allocation. I don't know how long I'll hold on to this bond ETF. Until I get a sense that the Fed is going to maybe start raising rates again. Maybe I'll hold it till then. I won't need the cash for quite a long time, so I'm okay there. But tell me what you're doing. Tell me how you respond to this rate cut. Tell me, you can tell me all the stories about why you think they cut the rates. There's already been some really interesting conversations about that. I personally do not think the Fed is political. Is there unconscious bias in the back of Fed governors' minds? Possibly. It wouldn't surprise me, but I don't think they do things for political purposes. You'll tell me. Let me know in your comments. Thanks, and we'll talk to you again. Bye.